All right, hey, welcome to Furstenau Financial. I'm Ryan Furstenau, and this is Kennedy Hideoff. Kennedy,
Hello, hello.
thanks for joining us.
Yes,
It's
thanks for
been a
having me.
while since Kennedy's been with us, but she has a bunch of questions, and really our subject today is going to be capital gains made simple. And so I know capital gains kind of sounds like it could be a scary thing or something that maybe is confusing. And we do get a lot of questions on capital gains. And so we just want to take some time to go through some of the things that we are hearing from clients and answer some of the things that you might be wondering about with capital gains. So, Kennedy, should we just hop in and
Yeah, yeah.
start talking about it?
Yep, I have a ton of questions.
Okay.
I feel like me personally, I hear a lot of clients and everybody talking about capital gains. So, what are capital gains?
So, I mean, capital gains are pretty simple. It's basically when you bought something and you own something at a certain price, and then you sell it at a different price or a higher price, you're going to have a capital gain. That's really all a capital gain is. So you bought something for $1,000 and now you sell it for 1,500. You have a $500 capital gain.
Okay, so when do you pay the capital gains? Is it just when you sell or how
Well,
does
yeah.
that work?
So what do you mean? When do you pay the capital gains? What do you mean? Like when do you realize that $500? When does it matter?
Yeah, sure. When does it matter? That'd
Okay.
be a good.
So it matters when you sell.
Okay.
So your value could go up from 1,000 to 1,500, but if you haven't sold it, there's no realized capital gains. So there are two things that they talk about. There's unrealized capital gains and there are realized. So unrealized means you have this gain, but you haven't used it. You haven't realized it and gotten that profit or taken the profit. Realized capital gain is when you actually, hey, I ended up selling it this year and I realized the capital gain.
Okay. Gotcha. Is there a difference between a short term or a long term capital gains? That's something I've seen.
Yeah, so there are different things. So basically, short term versus long term depends on how long you've owned it. So if you've owned it 12 months or less, or under 12 months, you are in the short term capital gain world. If you are over 12 months, you are in the long term capital gain world.
Okay, so you said a year, 12
Yep.
months.
Yep.
Why does that matter?
Because it matters what you're going to owe in taxes.
Okay.
So we've talked about the gains, and really the implication is, why do I care? Okay, I had a gain, great. It's called a capital gain, but that matters because you're going to owe tax on that capital gain. So if I bought something for 1,000 and sold it for 1,500, now I sold that, I made $500. The government is going to make you pay some tax on that. So you don't get it for free.
Mhm.
And if I owned it for 12 months or less, I'm paying at the short term capital gains rate. And if I've owned it for more than 12 months, I'm paying a long term capital gains rate. So there are different tax rates depending on which one you have. So a short term, it's taxed at your federal income tax bracket,
Okay.
and a long term is taxed at capital gains rates. And capital gains rates are either 0, 15, or 20% currently, depending on what your income is. If your income is low, you're probably paying the 0% on the capital gain. So that's a pretty good deal. But most people fall into the 15% category. That's the biggest range of income. And then some really high earners would fall maybe in the 20%.
Okay, so not everybody is the same rate.
Not everybody's the same rate.
Gotcha.
And it depends on which type of capital gain you have, which rate you're paying, because that short term would go back to whatever income tax bracket you're in, not capital gains tax bracket. So short term income bracket, um, long term capital gains bracket.
Okay. So, I know we've had, like I said, we've had questions, clients, everybody asks about this once they realize what it is, I suppose. Can you give me a real life example?
Of like when somebody would have a capital gain.
Yeah, or something you've seen maybe recently.
Well, I think the capital gains can kind of come in two ways. So we have kind of what we'll call embedded capital gains, and we'll have maybe the realized capital gains. And embedded means, so a lot of the things that we own in the form of a mutual fund or maybe an ETF, you own many companies in one investment. Okay. And inside of that investment, you might have transactions going on where something was bought and something was sold, and you didn't do it, but it was inside of that investment. Well, if there's a gain in any of those transactions, that gets passed along to us as the investor. Okay. And so those are declared capital gains. So even though we didn't maybe sell our core mutual fund, there might be capital gains inside of there. So we do get a lot of questions on that because at the end of the year, they may say, wow, you owe 500, you have $500 in capital gains. And you may say, well, I didn't sell anything. Ryan just said, I only get capital gains if I sold something.
Yeah.
Well, your investment sold inside of there, so you have to pay the capital gains in the year that they occur inside of that investment. Okay. And so you would owe some tax on that. The other side is, well, if I own that mutual fund and I sold it for a $500 gain, I would owe taxes as well. So you could have both scenarios going on in that real world example. But I think the internal capital gains are important because people are like, well, I didn't get the money and put it in my pocket, but I owe taxes on it.
Yeah, that's confusing.
Yeah, which you do owe the tax on it. And so, you either have to come out with the money out of your pocket, out of your checking account to cover that tax, or you could sell some shares to pay the tax. That may be an option as well. You're not going to own as many shares then, but you could sell some of that investment to cover that tax, which could then create additional capital gains. But the important part about the capital gains that are in those mutual funds or those ETFs, if they have them, is we are reinvesting them. So if they declare a capital gain of $500, we've turned around and bought more shares with that. So your new tax base has increased. So if your tax base was that 1,000 because that's what you started with, and you had a capital gain of 500 that they declared, your new base isn't now 1,000, it's now 1,500. So that's kind of a confusing concept. But if you were to sell it the very next day at 1,500 because you paid taxes on that gain, you don't owe any tax because you've already paid taxes on your 500 gain. So it's kind of like those embedded capital gains or those declared capital gains. They are kind of ratchet. You're paying a little bit of tax as they occur annually. And so if 10 years goes by, your base probably isn't that same 1,000. It's probably increased over the years such that if you sell it for 10,000, maybe those reinvested gains have gotten your base up to 5,000. So you'd only have to pay on that 5,000 gain. So it's kind of like pay the tax along the way type thing that happens with that.
Okay, and this all just kind of happens automatically,
So why are those gains happening? Or why, or the base that I'm talking
I don't
about?
even know that this is going on, right?
No,
this
no.
happens. I might see it on a statement or something.
Yeah, you're going to see it on a statement. So the investments are creating those capital gains in there through the transactions. You're going to get a statement at the end of the year that says, hey, you had this many capital gains. We reinvested shares. It all happens automatically. And you're going to get a tax statement at the end of the year also that says, hey, because of your gains, you have some taxes. Take it to the tax guy and he'll sort out the numbers for you. So there isn't anything you need to do with it, but you do need to be aware of it because this is happening on your investments and will continue to happen. The other thing to point out is it only happens on accounts that are not retirement accounts.
Oh, okay.
So if you have an IRA or a Roth IRA or maybe a 401k, you might have capital gains that are reinvested to buy more shares, or you might sell something in there at a profit. But as long as that lives inside of your retirement account, there's no tax that you're going to owe on it. So that can kind of roll forward until the day that you sell it. And then depending on what you have, there might be taxes down the road, but not along the way. So this really is applying what we're really talking about is just regular Ryan investment account or Ryan and my wife, Ryan and Shelley investment account that's not in a retirement account. That's when capital gains matter for taxes.
Okay, so this might be a silly question, but the different a Roth IRA or traditional, how you pay tax on one at a different time.
Okay.
Is that the capital gains built into that, or there's just no capital gains?
There's no capital gain on retirement. There's no capital gains tax on retirement. Nope. The little bit different subject, but Roth IRAs grow tax free.
Yep.
IRAs, you get a tax deduction, but when you take the money out, you're always paying your income tax bracket on IRAs or 401ks that are pre-tax when you put those in. So capital gains tax doesn't apply to those things.
Okay. So what happens if I lose money on an investment?
Okay, good question. So let's say you invested 1,000, but you sold it for only
Mm.
$500. So you lost $500. So that's actually called a capital loss. Okay. And so you can use that capital loss to offset capital gains. Maybe I had two investments and I bought one each for 1,000. I made 500 on one and lost 500 on the other. They offset. So even though you had a gain on one, they offset so you wouldn't owe any tax in the year that occurs. Tricks,
Okay.
but one of the things to be aware of is um, capital gains or capital losses can only offset capital gains for your tax purpose, unless you don't have enough capital gains, and then you can use up to $3,000 towards income tax.
Okay, this is getting interesting. Like
So
this is
yeah,
in depth.
but that's, I mean, your tax guy would know this, your tax person would know this. But yeah, because you might say, well, I sold something for a loss, but I didn't have any capital gains. Well, do I lose that loss? You don't. You could use it for up some of your income to offset some of your income for the year up to 3,000. But if you don't have any additional, if let's say you had 10,000 in capital loss and you can only use 3,000 and no capital gains, you could go and take that to the next year. So you can carry it forward until a time when you do have capital gains.
Okay, so what are some strategies to reduce your capital gains?
Well, I mean that's one. If you have capital
Yeah.
losses, you're going to use it to offset capital gains. And so let's say you had some capital losses on the books. All
Mm-hmm.
right. Let's say for whatever reason I had 5,000 in capital losses, and I have some gains in a investment right now, but I haven't realized them. I haven't sold them yet. Well, maybe it might be okay to sell them, even though I wasn't quite ready to, and use that capital loss up in that year, take my profits, reinvest it in something else. And that way I've kind of canceled out that gain that I had in there. So you could use existing losses to offset gains that you haven't realized yet. So that's one strategy. Another strategy is what they call a tax loss harvesting. So kind of the same strategy, but maybe you have investments that are showing a loss on paper, but you haven't realized the loss yet. Well, maybe it might be a good time to sell for that loss, reinvest in something else that may be better because you're showing a loss. Well, maybe it wasn't such a good investment anyway. And then you could use that to offset other gains you might have. And that's one thing we've done in down markets for clients is we've looked at the portfolios, we've looked at things that are maybe down, and we've sold those and realized some losses to offset some gains, reinvested it in something else so we can still continue to grow, but take advantage of that when there are down markets. Right now where we're talking today, we haven't been able to do that because we've had some very good markets. We have a lot of capital gains on the books, but we don't really have any significant capital losses at this time. But things will cycle, and then maybe that'd be a strategy again in the future.
Okay, so it's tax season. Somebody brings in their taxes and they owe $5,000 because of their capital gains.
Okay.
Where are we getting that money from?
So where would they get the money to cover the tax?
Yeah.
Well, so if you have a 5,000 capital gain, you're not going to owe 5,000 on it. You're
Okay.
going to owe either that 0, that 15, or the
Mhm.
20%, or maybe whatever your income bracket is, depending on if it's short or long. So let's say it's 15% or like 20% is easy math. So you would owe $1,000 on the 5,000. So you'd have to come up with 1,000. So you either, come up with money out of your
Mhm.
checking account or your savings, or we could sell some shares of one of your accounts to then send you the money and then you pay for the tax.
Okay.
Yeah. And that's okay to do that because sometimes those embedded gains, those gains that happen internally, you're like it's a surprise because you didn't sell anything, and it's an okay strategy to do that if you don't have the cash flow to cover it. So
Okay. So what are some common mistakes people make with capital gains?
common mistakes. The one big mistake is maybe more. I mean, twofold. People make investment decisions because of the gain or loss that they have in their portfolio. Okay.
Okay.
So let's say I invested $1,000. Now my account has gone down and it's $500. Okay. I don't want to sell at a loss, so I'm not going to sell. Well, maybe that investment isn't as good as we thought it was. Maybe we need to get out of it and get into something else. But people are reluctant to sell at a loss because they don't want to have a loss. When maybe it's a better investment decision to change to something else that has more potential to recover that loss than keeping the same one. So people will want to hold on to things that have losses because they aren't back to even. You say, when I get back to even, then I'll make a change. Okay. Then, but on the flip side, we get the other thing. Let's say my $1,000. Take an extreme example. My $1,000 has now grown to $100,000. Well, I can't sell that because I have a 99,000 gain. I'm not going to pay 20% tax on that. That's crazy. You can't make me do that.
Yeah.
But what if that was the only stock I owned? What if it was the only company I owned and then they went bankrupt? Okay. Well, guess what? I don't have to worry about I don't have to worry about a 20% tax anymore. I have $0. So we especially see that like with people that have they work for a company and maybe they get company stock as part of their benefits. So they built up a lot of stock in one company, and if that company were to go bankrupt, it's a big, it's a risk because you're really concentrated. Well, they have a huge capital gain in there. They're really reluctant to reduce that because they don't want to pay the capital gains. In fact, there's a story that I heard. Now, this was over 20 years ago, and I think I have the securities right, but Merck owned they're a pharmaceutical company. They had a Vioxx heart medication or something. Okay. So the story is the gentleman came into the advisor's office and he said, help me out, help me diversify my portfolio. What should I be doing? Well, he looked at the guy's portfolio. Well, he had a whole bunch of Merck stock. Okay. And at that time, the guy had a $5 million tax bill if he sold it. So his tax bill was $5 million. So he had a huge capital gain in it.
Wow.
And I don't know what capital gains rates were then, but he's like, I can't afford to pay $5 million in taxes. And the advisor came up with strategies like, hey, we need to do these things to improve it. And the guy said, okay, he walked out the door and never came back. Okay. So the guy didn't listen to the advisor. And the advisor picked up the paper like a week or two later and come to find out that Vioxx, it was a heart medication, I think, and there was something wrong with it, and the Merck stock had tanked. Well, the guy didn't have a big capital gain anymore, and he didn't have to worry about $5 million in taxes because the stock share price just plummeted. So you don't want to make investment decisions, purely because of the tax implications. So you want to make investment decisions for investment decisions and maybe use some other strategies to help with the taxes.
Okay. That was kind of my next question. Like, how do you balance tax planning with making good investment decisions?
Yeah. And there are ways to do it. There are strategies we can use. Maybe if I have a big gain, maybe I sell some of it now. Maybe I sell some of it next year. And spread that out over multiple years. If you look at the brackets that you're in, well, maybe I'm in that 15% capital gains bracket, and I could sell quite a bit and still stay in that bracket without triggering the 20. Mm-hmm. So you're like, okay, that's okay. I'd rather pay 15 than 20. So you can use different strategies to kind of minimize, that effect, or strategically, you're going to pay the tax, or strategically, maybe try and not pay as much as soon type thing. So. Yeah. And there are some new investment strategies that we have that can, help with some losses that would offset some gains. So there are many different things you can do.
So I'm in the right hands, you're saying.
Yeah.
Okay.
So our goal is to create capital gains because we'd rather make money and pay taxes than not make money.
Yeah.
So capital gains are good. That means we made money. And then it's just a matter of managing, how are we going to cover the tax on that, going forward.
Okay. Well, this is a little less intimidating than when we started, I guess.
Yeah.
For me.
Not too bad.
Not too bad.
Yeah. So, you might not remember all the things, but, I think it's good, kind of a good background. And then you can, just always ask us questions. That's what we're here for is questions like this, questions on other subjects. We know you're interested and concerned, but we know you're not the expert. So we want you to reach out to us when you're thinking about those things so we can help you through that. These are sorts of things that we can also visit with your tax planning professional and come up with strategies. How do we, modify the investments or change things to help through a capital gain situation or a capital loss situation, and just get you on the right track. So So hopefully this is helpful to you
Yeah.
a little bit.
Yeah, I'd
So,
say so.
all right, great. Well, thanks for joining me. We'll probably do it again sometime soon.
All right.
All right. Thanks, guys.